So, John, one of the things I look at, because I was a lawyer, still have my bar card, is covenant light. Is that an indicator? I mean, if you're saying the real question is, can you pay it back? If you were confident you'd pay it back, you wouldn't be hesitant to give the covenant. The fact that you're not willing to promise it, doesn't that give you some indication that maybe it's not going to be so easy to pay it back?
Well, I don't know. I think from a company's perspective, they're on the other side, so we're essentially lending on our client's behalf. They're borrowing the money. They want the best terms they could possibly get. So I think it's really just a question of, is the market open for it? So if you don't need these constraints, why put them on yourself? And the market is not demanding it. So you're seeing more of this covenant light issuance.
So why didn't you see the underperformance of investment grade? What have you made about that when we see the sell-off in an equity market?
Yeah, look, I think most of that, frankly, has been technical. So there's a lot of bonds, as we were talking about. Corporates have taken full advantage. Huge issuance in corporate bonds. So there's a lot of duration out there. So with interest rates going up, investors, have gotten concerned about that, and we've seen some outflows just purely from interest rates. And so corporate bonds as well as government bonds have had mostly negative returns this year. We haven't seen that in a while. So there's that. The second thing, though, of course, is the concern about supply. So not supply from new issuance, but also supply from pharma and tech companies who have these huge portfolios of investment-grade corporate bonds, one of the biggest buyers. And now they are stepping away. I think best case scenarios, they're sort of stepping away. And worst cases, they actually start selling.
So credit risk or duration risk? Which one
you prefer?
Yeah.
Ooh, that's a tough one. Well, I would say if you're asked that question, I'd say credit risk is you're still getting paid. We would suggest there is still a credit risk premium. It's not that high, but it's positive. In interest rates, we would say the term premium, the return, the extra yield you're getting to extend maturity, given our view on the economy and the Fed, is actually still negative.